In this video, we're going to be performing a deep dive on Microsoft's dividend safety. To begin, let's talk about Microsoft's business model. Microsoft develops, manufactures, and sells both software and hardware to businesses and consumers. Its offerings include operating systems, business software, software development tools, video games, gaming hardware, and cloud services. Microsoft was founded in 1975, is headquartered in Redmond, Washington, and currently trades with a market capitalization of $790 billion. Microsoft is a well-known dividend stock because of its size, dividend growth rate, and dividend growth prospects. With 14 years of consecutive dividend increases, Microsoft is a member of the Dividend Achievers, a group of elite dividend stocks with more than 10 years of consecutive dividend increases. For the remainder of this video, we will discuss Microsoft's current dividend safety from 4 perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Microsoft's dividend safety in the context of the company's current earnings. On October 24th, Microsoft reported financial results for the first quarter of fiscal 2019. The company generated $1.14 of diluted earnings per share during the 3-month reporting period. For context, Microsoft currently pays a quarterly dividend of 46 cents per share, which implies a payout ratio of 40% in the most recent quarter. Looking out over a longer time horizon, our conclusion is the same. Microsoft generated $3.88 of adjusted earnings per share in fiscal 2018 and spent $1.68 in dividends for a payout ratio of 43%. Using earnings, Microsoft's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Microsoft's current dividend payment to its free cash flow. In the first quarter of fiscal 2019, Microsoft generated $13.7 billion of cash from operating activities and spent $3.6 billion on capital expenditures for free cash flow of $10.1 billion. The company spent $3.2 billion on common share dividends during the same time period, for a free cash flow dividend payout ratio of 32%. Using free cash flow, our conclusion is the same. Microsoft's dividend appears safe for the foreseeable future, and its payout ratio using free cash flow is actually lower than the earnings per share equivalent. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze Microsoft's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Microsoft's performance during this time period is shown here. Microsoft's earnings per share performed very well during the last economic contraction. The company only experienced 1 year of negative earnings growth, and earnings rebounded to a new high in the subsequent fiscal year. With that in mind, we have no concerns about the company's ability to pay rising dividends during future economic downturns. The last angle that we will use to assess Microsoft's current dividend safety is by looking at the company's debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before its free cash flow will no longer cover its dividend payment. In fiscal 2018, Microsoft generated $2.2 billion of interest expense and had $77 billion of total debt for a weighted average interest rate of 2.9%. The following image shows how changes to Microsoft's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, Microsoft's weighted average interest rate would need to rise to about the 12% level before its dividend would no longer be covered by free cash flow. Accordingly, we believe that Microsoft's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Microsoft's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.